Good afternoon, everyone. Thank you, CFA Society, for having us here today. My name is Will, and I'm joined here with my teammates, Gannon and Lindsey, and together we proudly represent Concordia College. Today, we'll demonstrate why we believe Lifetime is both undervalued and built for durable growth. We initiate a buy recommendation for Lifetime with a 12-month price target of $50.74, representing 90% upside from yesterday's close. So why is this? Well, we view Lifetime not as a traditional gym operator, but as a differentiated lifestyle brand that continues to scale with stable revenue and loyal customers. We see Lifetime as a great investment opportunity due to three key theses. One, their access to a robust target market with an extremely strong consumer base. Two, they're well positioned to benefit on the shift toward a healthier world and premium products. And three, their transition to an asset-light model continues to help them drive scalable expansion. And now I'll pass over to Gannon to expand on their business model.
Thanks, Will. Lifetime operates premium, destination-style athletic clubs offering a vast ecosystem of wellness services, including personal training, digital fitness, family programming, spa offerings, and many more, all under a single membership. Founded over 30 years ago, Lifetime has 180 clubs spanning across the United States and Canada, with 70% of the revenue coming from membership dues and enrollment fees, while the other 30% comes from in-center ancillary services. This recurring engagement-driven model sets up Lifetime for expansion to continue their asset-light expansion model and set up for stable revenue streams. This leads us into our first thesis. Lifetime serves a high-income, family-oriented customer base that has continued to remain resilient despite economic pressure, reflected by a median household income of $169,000 and home ownership rates at 73% among members. These demographics support consistent engagement, with average visits per membership continuing to increase over time. In a K-shaped economic environment where high-income earners continue to spend, Lifetime's premium positioning supports retention, pricing power, and stable revenue streams. I will now pass it over to Lindsey to discuss our industry overview.
Thanks, Gannon. The wellness industry that LTH operates within is a growing sector, valued at $6.8 trillion in 2024 and rising. Consumers are spending more on wellness, especially younger generations, with millennials making up over 40% of wellness spending. Full-service fitness clubs face high structural barriers, driven by capital requirements, regulatory environments, and customer switching costs. Real estate constraints are also a challenge due to competition, and this is compounded with the layers of approval that are required for full-service clubs like LTH. The wellness industry isn't immune to industry headwinds, and economic downturns are still a concern, especially if members choose to trade down to lower-cost clubs. New builds are heavy capital intensive, with new builds exceeding $30 million, and construction costs have been on the rise, with non-residential construction inflation sitting at 3.8% since 2011 and 4.7% on a 30-year time horizon. This leads us to our second investment thesis, which is about the global shift towards health and premium products. The wellness industry has seen continued growth and has made great progress recovering from the COVID-19 pandemic, with 5.6% increase in 2024 in U.S. fitness memberships. Young, high-income individuals have been very receptive to these wellness trends, and they've really responded well to Lifetime's structured fitness experience. Lifetime has truly proven their adaptability to these wellness trends, proven in their diverse offerings that are available to their members. And now I will hand this over to Gannon to talk through financial performance.
Thanks, Lindsey. Lifetime's financial performance has improved significantly since the pandemic, with EBITDA margins expanding as mature centers become more efficient. As Lifetime has grown, they have also been able to generate more revenue from each member, demonstrated by the revenue per membership growth. These improvements in earnings and monetization support balance sheet stabilization as debt to EBITDA declines and cash flow improves. Additionally, over time, Lifetime has been able to increase their asset turnover, demonstrating increased productivity at existing centers. These trends highlight increasing profitability, financial stability, and capital efficiency across Lifetime's business. This leads us into our third and final thesis. Unlike competitors such as Planet Fitness and Exponential Fitness, which shift ownership and operating responsibility to franchisees, Lifetime operates their clubs directly. As a result, they carry larger capital requirements and greater balance sheet leverage, which we believe has contributed to the valuation discount relative to franchise-based peers. Since 2015, Lifetime has utilized sale-leaseback transactions as a way to shift capital that has been tied up in real estate back into the business while maintaining full operational control of their clubs. Projected club level cash-on-cash returns under this model support scalable growth without any need or any reliance on franchising. This reinvestment not only boosts operational growth, but steadily improves return on invested capital, increasing efficiency and long-term value creation. We believe the strategic transition will help narrow the perceived capital intensity discount over time. I will now pass it over to Will to discuss our valuation.
Thanks, Gannon. For our valuation section, we use a discounted cash flow analysis and a relative valuation with 75% and 25% weights respectively. We overweight the DCF due to its ability to capture Lifetime's unique capital structure, and it also allows us to highlight the key drivers of their business. We split our DCF into 3 stages: expansion, maturation, and consolidation. What you have to believe is straightforward. Lifetime can continue to execute its center expansion plan, their per center economics will remain durable, and their business will reach a free cash flow inflection point. Our model is built upon one core principle: capital expenditures drive revenue. Total value creation depends upon how many centers are built, how effectively they scale, and how well memberships are monetized. In short, CapEx is the backbone, and we divide it into 3 main compartments: new centers, maintenance, and modernization. Assuming consistent square footage and membership density per center, total CapEx is primarily driven by management center build guidance. Management recently raised guidance from 10 to 12 to 12 to 14 centers annually, with 13 already under construction for 2026. In our forecast, we see new centers peaking at the 12 to 14 range and then gradually declining thereafter once in the maturation period. Now let's take a look at how this connects to revenue. By aligning our forecast with key metrics and guidance from management, we then can derive revenue directly from capital deployment. We take revenue per membership, our key metric, scale it to membership revenue per center, and then to total revenue. We then adjust total revenue by a ramp factor to account for centers that are not yet fully operational. For our revenue per membership growth rates, we also apply a 3-stage approach. Previously, revenue per membership has grown anywhere from 10 to 12% in the previous years, and in our forecast, we assume Lifetime does roughly half of that for the coming years. Ultimately, what you must believe is simple. Lifetime can continue to build centers that have relatively similar format to previous ones and grow revenue per membership at a moderate pace. And now I'll pass it over to Lindsey to discuss risks.
Thanks, Will. Lifetime is not without risk, and tariffs continue to be a major topic of discussion, with the top 3 impacted materials being aluminum, steel, and textiles. 75% of these tariff costs fall on the end user, which directly impacts LTH. The fitness industry has also seen a dramatic increase in both customers and revenue within the digital fitness sector. And this change is compounded by the prevalence of weight loss drugs, which could disrupt the reliance on physical fitness facilities. LTH is pivoting though. They're offering natural supplement substitutions to weight loss drug GLP-1, and they have launched their clinic services, Miura. And now I will hand this over to Gannon for ESG.
Thanks, Lindsey. Lifetime integrates ESG initiatives into both their operations and culture. On the environmental side, the company has focused on reducing Scope 1 and 2 emissions, and also being a part of the Department of Energy's Better Climate Challenge. Lifetime currently has 5 employee-led affinity groups, which has gone from over 64 members in 2022 to over 2,700 in 2024. These employee-led affinity groups help employees create new relationships, find mentorship opportunities, and also have access to resource sharing. CEO Bahram Akradi's persistent dedication to guiding Lifetime throughout their unique experiences with private equity demonstrates his belief in the potential value of Lifetime. Additionally, since 2021, stock awards have been an increasing portion of named executive compensation, aligning management incentives with shareholder performance and long-term value creation. In summary, we believe that Lifetime is an undervalued business, with the market leaving 90% upside on the table due to 1, Lifetime's robust target market and highly engaged customer base, 2, a global shift towards health and premium products, and 3, a lack of recognition of the value created by Lifetime's asset-light real estate strategy. We will now open it up for questions.
Oh, thanks, Roger. So guys, good job. I actually love your ramp analysis, as well as first time mentioned tariffs. So good job on that. Just curious, like your DCF target price is pretty robust. I'm just curious how you have done from your relative value, valuation. Is there a big gap between what there are relative valuation versus your DCF analysis?
Yeah, so our relative valuation, we do EV to EBITDA multiples compared to Planet Fitness, Exponential Fitness, and then Soho House. And then the relative valuation price target was around $44 per share. And so that is a little bit lower than what our DCF has, but we do a blended average of the two to come to our $50.74.
Thank you. You mentioned at the top of your presentation that this is really a lifestyle brand. Maybe talk a little bit about that brand concept. How do you go about evaluating how strong a brand really is? And how do you go about figuring out if it's durable?
Yeah, so one of the key things that Lifetime focuses on is they pride themselves in their customer experience. They have raised revenue per membership 10 to 12% over the past 5 years, and the amount of visits that their members have has also grown. So members are willing to both pay more and they're willing to visit more. So their ultimate goal is to capture the lifestyle of health and wellness, and they've been continuing to do so. So that'd be my answer for that.
Yeah, and to kind of add on to that as well. I know that I mentioned personal training, digital fitness, family programming, and spa offerings, but there is a wide variety of offerings that are in-center services that Lifetime is willing to offer their customers. And that just goes in to show the way that they're trying to portray this as a lifestyle brand more than just the value of Lifetime. So.
And maybe in your DCF, since the sale leaseback financial engineering is important to you, how did you layer that into your DCF in that, and what assumptions did you make on selling real estate, which yields cash, reducing debt, but then you're going to put capitalized lease liabilities back on the liability side of the balance sheet? How did you layer that into your DCF, and at what rate?
So it's actually not built into our DCF as a way that cash is being injected back into the business. But we started by building the amount of centers that we're going to be building out, or Lifetime's going to be building out in the future. But that cash that's being injected back into the business isn't necessarily portrayed in the DCF. It's just going to stay under CapEx. So.
Yeah. So our DCF is really built upon how many centers they build. So our centers, our forecasted centers, are split into 3 stages: growth, or expansion, maturation, and consolidation. And currently, management has centers of anywhere from 12 to 14 for the next year, and that is where we peak our centers at. And then from our centers, we can calculate our CapEx for all of our different sections, and then we directly link how many centers they build to revenue per membership, because we take revenue per membership times whatever our growth rate is, and then we times that by average members per center, and then we get average revenue per center. And then we multiply that by however many total centers we have projected to get whatever our total revenue is, and then we adjust it for centers that are not yet fully operational. So that's really at the core of our DCF, is how many centers they build.
Okay, and just one more for me. You put up a chart of EBITDA margins. If you decompose EBITDA margin into EBIT and D&A, is the EBIT margin growing? Is it growing at the same rate, or is most of the growth in the EBITDA margin D&A?
Yeah, so their EBIT margins have been growing, and street forecasts expect them to grow over the next 3 years. So that's actually what in our DCF our EBIT margins are based off of. I believe it's up to 17 or 18% by the 3rd year. So margins as for EBIT are growing. Do you want to talk about EBIT?
Yeah. So over in the earnings call 2 days ago as well, CEO Barham Makarati heavily mentioned that he wants to keep that long-term EBITDA margin at about 25%. He doesn't want to go much over it because he wants to be able to create a customer experience that is unique to other competitors. He wants to be able to recycle that capital back into the business, and he wants to maintain at that EBITDA margin of 25%.
So making sure that you said EBITDA margin of 25%, correct?
Yes.
Okay.
Guys, I'm curious to hear about the importance of this as a lifestyle brand and as a luxury lifestyle brand. Tell me how that plays out against a potential K-shaped economy in the next couple of years.
So as for the K-shaped economy, Lifetime has continued to do really well in this environment, and they also have done well in poor environments. So in 2008 and 2009, they grew revenue by 13%. And this is due to their extremely strong consumer base, or their demographics, excuse me. Their consumers have a median household income of $169,000. 71% of their members are under the age of 55, and 61% of their members also have a college degree. So I say all that as to say that they have an extremely strong consumer base that's willing to go through ups and downs with their business because they value the experience that Lifetime offers them.
And
Please, go ahead.
Sorry, and I'll add on to that just a little bit. I think that lifestyle brand is really important because you can talk about fitness and you can talk about it being a place where you want to go and get healthy, but I think LTH is really making it much more than that, and I think that is one of the key pieces that is going to make it resilient and make people want to come back, because it's not just fitness, it's social, it's work, it's part of your daily routine, and I think that is something that separates it from other competitors.
So let me just ask though, what happens if, highly educated knowledge economy workers who are in that kind of income bracket are very heavily hit by AI in terms of their employment in the next few years?
Yeah, so that could definitely change, what we think of, our overall thesis on the company, as that is their target market. If that were to disappear, then it would be hard for them to, generate revenue. But they have shown resilience in terms of adaptability to new trends like pickleball. They've adapted really well to that. They're the #1 provider in the U.S. in terms of pickleball. So yeah, I think that they would be able to make it out, but it would definitely affect what we think of Lifetime overall.
The next time somebody is dooming at me about AI, I'll tell them pickleball will save us.
Yeah.
I also want to ask about the barriers to entry. So I think what confused me about that is I think a lot of those barriers to entry apply to each individual Lifetime club, right? Mm-hmm. They have to build each club, those expenses apply, all of the regulatory concerns apply. There's really no IP that they have that's exclusive. Anybody could clone what they're doing if they can get access to the capital, right? So talk to me about that.
Yeah, so obviously we believe that there's no other company that's like Lifetime, able to handle the capital intensity without relying on franchising. And we really think that if a company were to do that, it would require a lot of capital, and they wouldn't be able to do it to the same extent that Lifetime does. Lifetime has a real estate team, location intelligence team to be exact, that they use to find these locations, and it just shows the effort that they're able to put into finding these new locations. And we really don't think that there's going to be any other company that can emulate that.
So your price target is obviously a bull case, right? Strong bull on this. Taking the other side of it, what's a potential headwind that would happen that would maybe change your recommendation or your price target to the point where it's more of a hold or even a sell?
Yeah, if management can't execute the amount of centers that they have in terms of guidance, that would drastically impact what our share price is, because all their value depends upon how many centers they build, assuming that they have relatively similar format and they can grow revenue at a moderate pace. So in terms of changing our thesis and changing our recommendation to a hold or a sell, the first thing that would cause that to happen is if they weren't able to execute on expansion.
And did you stress test that variable at all?
Yeah, so across our cases, we start with our base case is anywhere from 12 to 14 centers for our first period. And then for our conservative case and our optimistic case, that's deviated by about 3 or 4 centers. And over time, that adds up. So that's how we stress tested it.
And what was the price target on those, more conservative?
So our more conservative price target was $33 about, and then our more optimistic price target was about $70. So it's a pretty wide range. So we did account for different scenarios.
So with those more optimistic assumptions on price targets, again, what do you think Mr. Market that tends to be efficient is really missing here?
So I think that the market is, needs more proof. They're in a capital-intensive industry that is subject to cyclicality, and it might be hard for the market to bank on the fact,